Welcome to today's Explainer. Today we're putting on our sell-side equity analyst hats to execute a really rigorous valuation of Tanger. We're going to look under the hood, apply some absolute and relative valuation models, dig into the cash flows, and figure out if the market's current enthusiasm is actually justified by the underlying fundamentals. Let's get to it. Okay, starting right off with the baseline. Tanger's last closing price sits at exactly $36.85 a share. That's our anchor, right? It's the number the market has collectively decided this company's worth right at this very moment, giving it a market cap of roughly $4.3 billion.
But right out of the gate, we've kind of got a mystery on our hands. When we run our discounted cash flow model, factoring in projected unlevered free cash flows and standard weighted average cost of capital, the intrinsic fair value we get for the stock is $36.52, literally just pennies away from its exact calculated intrinsic value. So when a stock is priced this tightly, what's the play? Do you buy the momentum, or do you wait for a margin of safety?
To figure that out, here is our agenda for today. We'll start with Tanger's market snapshot, move into returns and dividend yield, then dig into profitability and financial health, do a valuation multiples breakdown, and wrap up with our intrinsic value verdict.
Section 1. Tanger's market snapshot.
Let's get a high-level view of how the broader market is treating Tanger right now. We really want to understand the current momentum driving that stock price. And honestly, the momentum is solid. It's up over 12% year-to-date, and it's bounced an impressive 28.44% off its 52-week low of $28.69. Clearly, buyers have been stepping in, pushing the price up, and showing a lot of near-term confidence. Section 2. Returns and dividend yield. Now, when we analyze a real estate or retail-focused asset like this, investors are usually hunting for a reliable stream of income. But the data here really illustrates a tale of two timelines. Look at this stark contrast. Short-term momentum is incredibly hot. We're talking a nearly 29% trailing 12-month return. But if you zoom out, the annualized return over the last decade is a much more modest 5.65%. So this tells us that the recent massive run-up is honestly a bit of an outlier compared to its historical long-term baseline.
Looking directly at shareholder returns, kind of through the lens of a dividend discount model, the profile looks incredibly robust on the surface. Tanger is offering a 3.39% yield, and they've actually managed to increase that dividend for 5 consecutive years. Pair that with a comfortable traditional payout ratio of around 65% and a 5-year dividend compound annual growth rate approaching 12%, and it looks like a rock-solid income play.
Which brings us to Section 3, Profitability and Financial Health. As analysts, we never just take those surface-level metrics at face value, right? We've got to look under the hood. Does the core business actually justify these returns? Well, what's really interesting here is the sheer baseline profitability of their operations. Tanger boasts a massive gross margin of nearly 70%, plus an impressive 18.58% net profit margin. Throw in a solid 7.27% return on invested capital, which, by the way, is actually trending higher than its historical averages, and you've got a business that clearly knows how to generate a return on its assets. However, here is where our diagnostic check uncovers a massive red flag. Check out this divergence. Over the last 5 years, net income has grown over 38% annually. Sounds great, right? But free cash flow, the actual hard cash left over after operating the business and maintaining capital assets, has declined by over 34% per year in that exact same period. It's like a leaky bucket. Those rising accounting profits just aren't translating into actual cash in the bank. So what does this mean for your capital?
Well, because of that severe cash flow drain, the trailing free cash flow payout ratio has literally skyrocketed to an alarming 838%. Remember a minute ago when we said the standard payout ratio was a comfortable 65%? Yeah, that was based on earnings. But based on actual free cash flow, the dividend costs over 8 times what the company is actually generating in free cash. This strongly suggests that the current dividend isn't being covered by organic free cash flow right now. Not ideal.
All right, Section 4. Valuation multiples breakdown.
So keeping that structural reality in mind, strong net income but rapidly deteriorating cash flow, let's do a relative valuation reality check to see if this stock is currently expensive. Look across the board here. Tanger is commanding a noticeable premium compared to its own 3-year historical averages. Its price-to-earnings, price-to-sales, and price-to-book ratios are all elevated. Most notably, we're seeing a 14% premium on its price-to-sales ratio. The market is definitely pricing in a whole lot of optimism here. And if you stretch that horizon out a bit further, the valuation looks even more strained. The current PE ratio is sitting over 92% higher than its 5-year historical average. Let that sink in. Investors are essentially paying double the multiple for the exact same dollar of earnings compared to what they paid on average over the last half-decade.
Finally, Section 5. Intrinsic Value Verdict. Considering those rich valuation multiples, the strong price momentum, and that glaring cash flow divergence, what is our ultimate fair value verdict? To answer that, we absolutely have to look at the margin of safety. In the world of fundamental valuation, this is the vital buffer an investor relies on to minimize downside risk. Simply put, it's the gap between what a stock is intrinsically worth and what you have to pay for it today. You always want a healthy, positive margin of safety to protect your portfolio.
And here's the crucial point. Tanger's current margin of safety, based on our absolute valuation models, is negative 0.91%. Yep, negative. Because the stock price is sitting just above that intrinsic value of $36.52, there is absolutely zero margin for error here. You are paying full price and then some for future cash flows that, as we just saw, are currently trending downward.
We've seen the stellar accounting margins, the solid momentum, and the historically robust dividend growth. But given those massive valuation premiums and the deeply concerning free cash flow metrics, we have to ask the hard question. With no margin of safety left, is Tanger priced for perfection or poised for a pullback? It's a fascinating standoff between market sentiment and underlying cash realities, and it's definitely one we're going to watch closely. Thanks for joining me for this explainer, and keep learning.